What are some of the key lessons you've learnt in creating your own business?
I've built the software since 2007. We built a tool for advisors to use. And early on, the lessons were really, well, there were a lot about how do we communicate this? Because it was a new thing for so many people we were talking to. Just really the best way to deliver the why of why you should use it and then how you should use it. We don't actively have a dollar spend for marketing at all. We do no marketing. We've just got a bunch of advisors that love it so much they tell their mates. So when those people start using it and then start saying good things about it too, then people really start paying attention. One of my biggest critiques of the industry as a whole in New Zealand, what tends to happen in financial services is that nobody actually tells them how to be an advisor. It's just sort of not readily available.
We haven't gone that far. We're just producing our own, this one, and then there's the 2 other segments that we've been working on that I'm doing currently on my own.
I already saw your Monday.
Macro Mondays.
Yeah, that's it.
Macro Mondays and Acuity Explorer. So Macro Mondays is there to be like, what does the macro picture look like from the context of someone living in New Zealand or Australia and trying to preserve and build their wealth and kind of in a very consumable and current like event sense. For example, I think currency is such an important thing to people in New Zealand. And the first episode I did,
And ours is all over the place.
yeah, very important part of everything to do with what we believe wealth to be in our own little bubble is tied to our currency, of course, because we buy a lot of stuff in different currencies ultimately.
So much. People don't realize in the US, don't realize how well off they have it being able to buy things like oil. I mean, everything's denominated in their dollar.
Yep.
So, I mean, that's hugely beneficial. They don't have to worry about that stuff.
Yeah, but we should think about it, and I think it's really important for people to also be aware of it in a more kind of
It's
true
the reason why
way.
it's so expensive to live here.
Yeah.
Because we import nearly everything.
Yeah.
And even the stuff that we're good at exporting is still expensive.
Yeah, because we have to set the price.
Yeah.
And it has to be comparable. Yeah, it's a difficult one. So it's relevant, right? So there are macro things that we have to think about here.
Yep.
And just be aware of, right? Because it's just good to know, like good to understand, rather than be like head in the sand, not knowing.
Yeah.
And then we've got this, which is talking to people about their story in a relatable way, because actually wealth is different from every single person. Everyone starts from a different place.
Totally.
And, there is no defined finish that is success or wealth, like, yes, okay, net worth is a bit of a scoreboard in a sense.
It's frustrating that it's actually most people's scoreboard and it's not, and that there's not probably another one.
No.
That's readily identifiable that people could then look to, right?
Yeah. Well, I said, what did I say to that one guest? How many people are going to turn up to your funeral, maybe?
Yeah.
Right.
And then the other one that we haven't released any episodes yet is Acuity Explorer, which will be taking a stock, ETF, or startup company and just spending 10 to 15 minutes researching it.
Yeah, right.
No view.
Yeah.
Just
see what you find.
Let's see what we find.
Yeah, right.
And with those 3 elements, we believe that that's a really great base to provide really great organic content where people can get some value.
Totally.
And that's where we're putting our efforts as a business is how do you just provide value to the market through information in a digestible way?
Yeah.
Because no one wants a 50-page PDF with
no.
a bunch of charts
No.
every day.
Yeah.
Because it can't be consumed. But maybe like a 8-minute video that's vertical is the way to do it.
The thing about
these days.
ETFs is that a lot of people don't understand, I think, is their weighting rules, right?
Yeah.
Like, what are they doing when they're rebalancing? Do they have any rules around tilting that depending on what's going on in the market, right? Mm-hmm. Moving away from one part of the index towards another, maybe. I don't even know where you'd find that without actually going direct to the ETF and going, hey, look, I need more information on this.
Yeah.
Unless there was a detailed research paper on it. Mm. Exactly. Because some of them do. They have all sorts of crazy stuff going on, and it works for them. It's why they do better than some of the other ones.
Yes.
You know?
Yeah, those idiosyncratic
Yeah.
kind of rules or decisions are basically, I guess, what make or break a bunch of these ETFs.
Yeah.
And, you know, nowadays there are actually just so many ETFs and so many quite advanced products you can get through ETFs.
Totally.
You can get hedge fund level strategies
Yeah.
from ETFs these days.
Yeah.
Well, you know, stuff that was basically not available to people in the past.
But you've got to know what to look for when finding them.
And, you know, I think the downside to it is like, what are the gotchas? There's always a gotcha.
Yeah, sure.
You know, you think about these covered call strategies.
Oh, the leveraged ones. The leveraged ones, right? Oh man, I remember pre-liquidity crisis. Or was it post? It was post. It was post-liquidity crisis, and
You're talking about in the GFC.
yeah. And so a lot of these were engineered to do well in certain environments without really, I think they weren't really thinking through what that would happen in an alternate environment. So, you know,
Yeah, I mean, you definitely say that.
markets would go up and they'd crank up 4 times or whatever. But then when you'd get a dip that they weren't expecting, they'd crash and die. Like what works one way will work in the other way for them too.
Yes, the unwind.
Yeah.
And I think that's, I would say that from current events. So this podcast is not so current, it matters currently because it's about people's stories.
Yeah.
But I would say a current event around that would be your major indexes that are considered beta.
Yeah.
That are no longer beta.
Right.
I don't think you can really hand on heart say the S&P with 30% of the index in large cap names to be true beta.
Well, I mean, you know, you could say the top 7, companies completely behave differently to the rest of the index.
yeah, well they have
Right.
done. Yeah, for the last couple of
So the fact that you're rolling all of that into one is like, well,
yeah, and just how the index is, like you say, the rules around it.
Yeah.
You know, market cap weighted means there are some severe consequences
Yes.
in this sort of environment.
Yeah.
And then that can take what has been known to be beta to no longer be beta. Actually, it's you know, at least it's at least based on the weightings, probably kind of veering on 30% alpha. Not really, because I guess they've always been a big part of the company, and they're the best businesses in the world. But yeah, you get these points in time, I think, where what's known to be normal is no longer normal, and that's where, you know, things happen that are strange. And what unwinds a lot of these leverage products, or in any sort of cycle, is that, you know, the fact that these marketable assets are in an auction-based system. So, you know, there just might not be a buyer on the other side.
Yeah.
And that dramatically affects the value of that investment for that point in time. And that's why Buffett talks about when you buy businesses, you know, it shouldn't really matter to you if the stock market would close for a couple of years.
yeah.
Which is slightly different to buying indexes and ETFs.
Yeah,
but at the end of the day, an ETF or an index is a group of businesses.
Yeah, that's right. That's right. Absolutely. I mean, he would tell that story when he was talking about, you know, his investment in Coke.
Yeah.
I think he invested pretty heavily at one point. For whatever reason, it had gone down, and he was going, well, people are still drinking Coke. You would go down to the local coffee shop and see if people were still buying it. And they seemed to be. So he's like, well, let's go. I talk about this, and I talk about this a lot with tech workers actually at the moment, often talking to people at the public companies, tech companies, and we talk about, and I've been notoriously relatively negative on the price of these businesses recently, whereas I still think they're the best businesses in the world. Yeah.
I think it's really hard to understand that I can think that something is the best business in the world, but the value may have, like the relative kind of value, it might not be a price I would personally want to pay, but I can still think it's the best business in the world.
Sure.
You know? And I can still think it's going to grow.
Well, yeah. I mean, you know,
There's a difference between basically
absolutely. Now, what a company does for a living and the value it provides in the larger sort of macro picture and ecosystem versus what people are willing to pay for it. Because a lot of those people might not be, you know, they're along for a ride. They're being sold a line, or they're jumping on a thing that they quite fancy of because whatever flavour it is, rather than actually being based on anything sound fundamentals. Yeah.
Well, I was talking to a fund manager, KiwiSaver guy, yesterday, and he's a really good mind, really strong kind of fundamental mind for investing. Knows a lot, been through the ringer. You know, was at Goldman, I think, in 2008.
Okay.
So experienced some stuff, and he was saying, you know, actually, really markets are, on a day-to-day basis, are not driven by fundamentals, like 80% of the time. And then there are moments in time where the market kind of recalibrates to fundamentals.
Yes.
And that's actually how kind of markets kind of tend to shift, and that's that reflexive nature. I won't mention him just because I don't know if he wants to be mentioned.
Oh, okay,
because of that view.
Right. Okay.
Yeah,
that's a perfectly reasonable view.
It is a perfectly reasonable view.
I would agree.
Yes, same. I think it's hard to be a KiwiSaver fund manager.
Yeah, sure, it is, because there's massive scrutiny.
Yeah.
And everyone's always comparing you to Milford.
And everyone and the S&P 500,
yes,
which they're all pretty much destined to underperform unless they put themselves out there. And obviously, putting yourself out there is creates a lot of
you're
career
kind of
risk.
screwed if you do and screwed if you don't, right?
Yeah.
Yeah. If you're tracking the index, everyone's saying, well, you're just tracking the index,
And you're underperforming because you're
And
charging a management fee. So.
Exactly. Yeah.
And if you don't, then you look different sometimes. Then that's even worse.
People don't like that either.
Yeah, it's a fun game. But you know, I thought having you on the pod would be awesome because of your background in financial planning.
Yeah.
And how I think that financial planning and estate planning are things in New Zealand that are not at the level of sophistication that other Western countries are at.
It's true.
And then your journey with Planolitix in terms of building a software company from scratch and bootstrapping it with your partner and building a beautiful product that other people use, that lots of advisors use. I thought that would be really cool to kind of unpack some of that story, but also then provide a bit of your kind of knowledge around the financial planning, because you're one of the few people left that actually do true financial planning, right?
There's only a couple of hundred CFPs around. There used to be more. Used to be like 350 or so, I think.
And a CFP is a certified financial planner?
Yeah. So that's a international mark coming out of the Financial Planning Standards Board in the States.
Okay.
It's in 70 odd countries around the world. And, you do get a certain kind of training. And this is one of my biggest critiques of the industry as a whole in New Zealand. What tends to happen in financial services is that people get given what I'll gently call persuasion training and some product knowledge, and they get kind of like shoved out into the world to go do something resembling selling. But nobody actually tells them how to be an advisor. Yeah. There's no training you can get on how to be an advisor. What's the philosophy you should have on the approach you take, how you do that. It's just sort of not readily available. CFP kind of goes down that track, but that really helps to have the right mentor to take you down that track. I was really lucky. I had a really good mentor, a guy who was now retired, but who was a long-standing, recognised sort of member of the industry. So I was super lucky to have him. Got my black belt there. That's how I kind of think about it.
Yeah, totally.
And then eventually just flew free on my own, and in 2007, amazing timing. It was May. Great timing to be buying all your clients off your employer, leveraging up your mortgage to do so, and then telling them to all go back to the bank by the end of the year.
Right, yeah.
It was pretty rough.
Oh man, I mean that's kind of that sort of timing is notorious when going out on your own and taking some risk.
It was wild.
Most people that get into investing at a top. Right?
Yeah, right.
And that's something, that's just the way it is. Because if it becomes generally interesting to a lot of people, that's typically a sign that it's well established. And it's not a bad thing to get in at a top,
Because you learn your lessons
Because
real
you
quick.
learn, you don't have to wait as long to learn your lesson.
Yeah. There's no fooling yourself with that thing where that rising tide that lifts all boats, including you and the performance of whatever you've done. And here's you thinking it was
Your skill.
You've done well, and actually no, that's just the momentum of markets moving in a certain direction. So the other is a way better lesson.
Yeah, and often, and you will have taught this, and it's probably most of your job is, hey, stick in there, right?
You gotta
stay
have
on
a
the
plan.
boat.
You gotta have a strategy.
Yeah.
That really helps. Yeah.
So in the financial planning realm, like, what are the characteristics then of like the clients that have been the most successful and have been the least painful for you?
It's interesting. It's amazing how little of it actually has to do with investment advice. A lot more of it actually has to do with strategy. And I think that point gets really missed too. The benefit of having someone who is a financial planner isn't necessarily about, hey, I'm going to engineer the world's sort of best portfolio. People think that's what your role is. And if you're a pure investment advisor and you're maybe largely babysitting people's money, then sure, it is all about that. But if you're not, and going back to the estate and tax planning thing, if you're not adding anything else, then actually where is the value in the fees that you're charging? And this is what financial planning starts to really look at quite hard, is that concept of, hey, who are you? What are you doing? Where are you going? What are you trying to achieve? And none of those things maybe have anything to do with investments,
No.
So it's then a case of, well, you've got a lot of things going on in your world. Maybe you've got debt, maybe you've got sort of assets which wouldn't actually show up in a portfolio, like properties, maybe you've got businesses. There's all sorts of financial management things you might want to consider. And that's before you get anywhere near investments. That's just all those foundation level building blocks of someone's total world that you might want to consider. And strategy is a large part of that, because a lot of people kind of go, well, I think I'm doing okay, but I'm not sure, And I've had people walk in the door and go, right, well, that was a really amazing session, thanks so much, but what's next steps? I'm going, well, you're already managing your own stuff and doing an okay job of it. You haven't done anything wrong. Everything's set up pretty sensibly. You might not actually need me, And one of my favorite clients, they went, wow, I've never we've seen two other advisors and no one said that yet.
Yeah.
It was so funny though, because they came back 18 months later and went, look, can we just like pay to come and see you? I'm like,
Yep.
Yeah, of course. I'm going, well, what's going on? He says, well, we just had such a great session and I've never forgotten it and I felt so good afterwards. They just needed that confirmation.
Yeah.
Yeah.
But there's also that ongoing discussion of having someone there to bounce ideas off a wall and confirm and
that
just
conviction
double check.
piece,
Yeah,
which I call a lot of
absolutely.
investing is about
Absolutely.
conviction, right?
Yeah.
And sticking with it, and that's why a lot of people end up selling their equities if they're on their own at an unopportune moment, because it's
Totally.
that conviction piece of, when it was going up, it was really exciting.
Yeah.
But when it's going down, I didn't have the innate conviction to stick through with it,
Yeah.
right? And I think that's something that becomes very apparent as well in like assets that are inherently a little bit more, I guess, speculative in nature, where it's hard to understand an intrinsic value or future cash flows. It's more about
Totally.
the asset itself. Which, gold and commodities would be a kind of a pretty good example of that.
Yeah.
I like what you talked about, because really what that client felt was value.
Totally.
Right? And in this country, everyone's been taught to pay their financial costs of their financial products indirectly.
Yeah, through third parties.
And
Less so with investments, but certainly true of mortgages, certainly true of insurances.
you kind of subtly are paying for it, and then it makes it, you don't understand what you've paid.
Absolutely.
And Australia and New Zealand.
But you also don't know when someone's done a good job necessarily either. It's a really interesting one. Like,
Yeah.
I know some mortgage brokers who are incredibly transactional. There's nothing wrong with that. If you've done a really good job about getting someone what they needed, that's great.
Right.
But if that's all the client wanted, that's okay. But if they're the sort of client that then goes, right, well, now we've got the debt, how are we going to get rid of it?
Yeah.
Well, then maybe you needed another kind of advisor.
Yeah, right.
And whether that's a different kind of mortgage broker or that's a different kind of financial advisor who actually, can do that kind of modeling, then that's a thing too.
Yeah, I think there's definitely going to be a shift now as people become a little bit more self-sovereign.
Yeah.
A little bit more interested in the assets that they own.
Totally.
There's definitely a high level of interest. And I think kind of with society and how the internet has changed the world, and there's been so much kind of, I guess, distribution of what happens in the world, people, I guess, are probably a little bit more, and you would know this better than me because you lived through some pretty volatile times. It seems like people are a little bit more accepting of volatility these days.
I actually think so. I mean, I remember being a young sort of planner because, in fact, how old would I have been? Very early 30s, I think. And it was actually hard because people would still remember like 1986. Right. And to be fair, New Zealand stock market took the longest to recover than anything else. The States, everything was, back to where it was, I think 18 months later or something, but we were like 12 years or 14 years or something.
Oh, wow, I didn't realise it was that long.
It was really long.
Yeah.
And so people were really, really anti-shares.
Yeah.
But the other thing too, and this is a double-edged sword, is that for the longest time, I think we had like a long-run interest rate of about 7% in New Zealand. And so fixed interest was actually a fabulous asset class.
Right.
Because it was genuinely super safe and you could get a return off it, which, briefly now we can, but for the last decade we couldn't.
Yeah.
No.
Right? It was too hard. And that was a real challenge for a lot of fund managers and people building portfolios. It's like, well, I know I'm supposed to have this much, but really it's killing us.
Yeah.
But
I'm not getting a yield and the value is distorted.
Yeah, and
But I'm
minus
still-
fees, it's a nil-sum game.
Yeah. And then, but I'm still going to do it because the book told me to.
Yeah.
And then...
And it's defensible in a court of law, and we're mandated to do it like that.
Yeah.
So
And it's considered conservative.
exactly.
But then,
Yeah.
and then 2022, 2021 and 2022 roll around and the regime shifts
Yeah. Again. Yeah.
again, and it always does.
Totally.
So yeah, interesting. So when you've been doing your financial planning, when did you decide to build Planolitix?
So it's a bit of an interesting one. How it happened was that the guy I was working for, he, as I said, he gave me an amazing sort of foundation and training, and but we had it was all Excel. Anyone on the nerd end of the spectrum is building their own stuff in Excel in New Zealand because nothing comes to New Zealand because we're too tiny.
Yep.
Okay. So I learned how to do that, and as I was doing my papers to get my CFP through Massey, and I was building my own things in Excel because it wasn't okay probably for me to use the tools that we'd created in house for that. He wanted me to do it myself, and at that point I realised actually. There was a lovely little moment, I remember, when I realised I might have something. This guy was a Mensa, my old boss, and I was writing a calculation for turning gross income into net income. Mm-hmm. And he looked at the formula box and he says, that can't be right. I went, why? He goes, that's not long enough. I'm going, what do you mean? He says, well, mine's 8 lines long. Yours is only 4. So it must be wrong. And we compared them and they were identical. The results were identical.
Okay.
But I'd gotten there by a much shorter formula than what he'd used.
Yeah.
And then I went, well, that was surprising. So I started to have this inkling that actually maybe I was capable of building something.
Yeah.
And then what happened was I left. I got my CFP, ended up going out on my own. And then I had to start building my own tools. So I started building my own kit the way that I wanted to do it because there was a bunch of stuff I didn't like about his one.
Yeah. So
in building that for me, it just so happened that that became a bit of a focus. I was renting space from Hannah McQueen at Enable Me, and she didn't have any tools for what she wanted to do either. She was using some B&Z software. And I went, Hannah, I'm just going to build you something because I'm sick of watching you do that with that awful little tool. And so I built her a thing, and I said, so look, it can do this, which means you can change things halfway through, and it's flexible. And she went, oh wow, can you make it do this, this, and this? And I was like, yeah. So after about sort of like 12 to 18 months and like about 25 different iterations of can you make it do this, this, and this, I'm kind of going, I never would have built it this way, but here we are. Yep. They used that. until about 2016 to sell their clients that came in the door into their services, basically. And it was all about that forecasting piece. It was all about, we can help you do this, and here's how. So yeah, I kind of got into it at that point. But I mean, I was never working for her. I was only ever a consultant and helping her pay the rent. But at that point, I got really, really interested in building more for me. And yeah, it just kind of grew and grew and grew and changed. And I just kept adding to it. And eventually, I found some people to help me get it out of Excel and into the cloud. And at which point we rapidly realized this is actually so cool. We kind of got to share, because there's that decision you reach where you're building something for you.
Yeah.
An in-house tool, very different from a tool that everybody can use. So we had a bit of a pivot, threw some more money at it, way more money at it, but then we ended up with this lovely little thing. But then the problem was like, right, well, I know why this is important because I've been cash flow modeling since 2001, but nobody else does, except for a very few people who were like me, who'd built their own stuff. But then, of course, because they built their own stuff,
They didn't need yours.
they didn't necessarily need mine. So we then had the problem of educating an entire industry as to what lifetime cash flow modeling is and why you should even be doing it.
Yeah.
Which, has had its frustrations.
How did you go about that? Like, how do you educate a group of people who don't necessarily know that need to be educated about something?
Look, seriously, it just actually came down to our business model, which we knew that people would be compelled, advisors would be, if they started using it, would be compelled to do it.
Okay.
If they just actually got off the ground and sort of got flying with it.
Yeah.
We knew that they would love it so much they'll just rave about it and tell their mates.
Okay.
So we couldn't really have a volume play to start with. We weren't in that space. It was all about a lot of attention and time spent and resource. And some of those early people, man, we just kept chucking the hours at them. But eventually, they were flying with it. And they did. And they raved about it. And that started to generate some interest. And eventually, the phone would just ring. And it's been ringing ever since. That's what happens now. Like, we don't actively have a dollar spend for marketing at all. We do no marketing. We've just got a bunch of advisors that love it so much they tell their mates. Yeah. And because we do tend to attract the better advisors in the first place, they're the ones that other people are looking to.
Yeah.
So when those people start using it and then start saying good things about it too, then people really start paying attention. Yeah. Totally. So that's kind of worked so far. So now next steps are building resource around training tools.
Yeah.
We've built a lot of resource into it already that's kind of just invisible, but it's there in terms of info buttons and little play symbols which then go out to our Vimeo page where there might be sort of like a little bite-sized sort of clip on how to use a widget. But we really we just know that there's stuff that advisors always need to learn about. So now we're going to create a searchable base, basically, of and every time we come across another issue, we'll create a video about it, which will go into the base, and then people can go from there.
Are you using a framework for that?
Yeah, not yet. It's still to be built. We're about to get to that. Our developers actually,
I would suggest,
have actually built an educational framework around video.
Oh, that they've already built for like another client.
Yeah.
Right, they've got the source.
Totally. So we're considering using that one. But
yeah, cool.
Maybe not. We haven't figured it out yet.
Yeah, we use a thing called Talk.
Okay.
TAWK. For our knowledge base and our support, really, and even our tracking of our sessions on the website, both the website and the application, because we have two layers to the product, which we find is really good for iterating on consumer kind of marketing and information, because using a traditional developer is relatively expensive. But yeah, they have really good search capabilities. Talk does, it's free, and a really strong knowledge base.
Cool.
So yeah, just like it would be, very cost effective, and it's a really great product. Just so you know.
Thank you.
A little plug for Talk. No, I like Talk a lot because they're lightweight. They're like a lot lighter weight than an intercom, but they actually have some great functionality and really cool stuff. And they're building a CMS out as well beyond that. So it's really interesting. It'll be interesting to see where their product goes. But yeah, just FYI, they're quite good if you don't want to build something natively because it becomes expensive.
Oh, look, you always got to look around at what's out there first. If only to even have a few good demos and understand what you like or don't like.
Take inspiration as well.
Yeah, totally.
That's right.
100.
So, you've obviously had like different evolutions so far in your life in terms of financial planning, moving into business and that kind of thing.
Yeah.
What was it that started you thinking, hey, I want to be a financial planner or I want to build my wealth personally?
Oh, I fell into it.
Yeah.
Yeah, it was a total fluke. And a lot of people fall into financial services.
Yeah.
Very few people leave school and go, I want to become a financial planner or
Yeah.
I want to become an investment advisor. You know. Yeah, no, I kicked myself out of home at the age of like 16 and then lost 10 years of my life. And so it was really commission sales that I needed a job.
Yeah.
And of course, it was the classic pane of glass test, sort of like, this is a commission sales job. Can you fog this pane of glass? Yes, success, you're in, right? And that was mortgage broking. But that was 1997. Like before mortgage broking was really a thing at all. It didn't really start to really come on stream till I reckon about 2001. People started to understand what mortgage brokers were and why I would use them. And then there was also a property spike around then too. But I'd already moved on by that stage.
Yeah.
Yeah. The place where I first got my training on how to be that mortgage broker, they weren't particularly great crowd to work for a bunch of reasons. They weren't very responsible. So I left and ended up working for an insurance brokerage in bottom of town, and they wanted a mortgage broking department. So I set one up inside there. We both sort of overestimated how much mortgage work there was going to be inside that base. So I started doing some insurance because that's what they did, and they had plenty of work on. So I started getting into that. And then I'll never forget, there's a guy called Barry Reed that a lot of people in the industry will know. He was my BDM for Astron. Back then it wasn't Astron, it was Royal and Sun Alliance. And he said, Royden, he says, why don't you do a bit of investment sales off the back of this stuff you're doing? I'm going, well, for the very obvious reason, Barry, that I know nothing about investment. He's going, it hasn't stopped anyone else. And that's the moment when I kind of went, wait, what?
Yeah.
I just thought all these people that I was going to these sort of seminars and stuff with and conferences that they knew what they were doing. That was my natural assumption, right? That that the financial advisors I hang out with knew something about how to do their job. I was horrified. And there's still a lot of that today. I mean, the bar for even getting into advice, the ticket to get in is a very, very, very entry-level set of exams, right? And once again, like I said, there's persuasion training and product knowledge, but how to be an advisor, how to do that other stuff is not being taught to those groups. You know, I mean, if you've started off in a bank and, you know, you end up sort of in a you know, going to a share broking firm or something, or you end up in private banking or that sort of thing, it's very different. It's very different. If you come from that, if you take that path, it's very different to the financial advisory path where you might start off.
Yeah, the depth of knowledge is clear. Like Anthony, who we had on the podcast, like he went to a bank for a time. He was also from the US, so he had a lot more exposure to different asset classes. But the conviction and the understanding of like what they're talking about is just so far greater.
Yeah, absolutely.
Whereas you may sometimes find that it's a huge difference, right? Like of someone that's actually allocated capital versus someone that hasn't.
Big time.
And yeah, it's quite interesting to see that. But actually, at the same time, you say, well, actually, that's a very small part of their job.
Yeah.
You know, really knowing about investing is a very small part. But I do think it would be really helpful for the industry if all advisors had some sort of acute appreciation for allocating capital, because and then you have more empathy around it, and then also you may question yourself what is considered conservative balanced growth, right?
Yeah.
Because then there's that kind of acute appreciation. Like we had Darcy on the podcast, who's someone that's quite curious, a little bit off piece in terms of if you looked at like the standard deviation of your average advisor, and where he sits on that kind of curve.
Yeah, I know Darcy.
And he knows he has a lot of that kind of first principles appreciation of different investment classes, and I think that really serves you well, and I think that also adds a lot of value to you as an advisor, because then you're actually like, well, people would pay to just listen to me talk and have a conversation with me. which is where you want to be where you want to be at as an advisor is you want to have all your clients feel like you're providing genuine value rather than necessarily being kind of more transactional with it. Like you say, at the same time, that's nothing wrong with that, especially in the context of a mortgage broker that's helping you get debt at an appropriate price.
If you're trying to get a thing done, and mortgage broking is also quite different compared to perhaps some of the other things as well, because everything's an emergency, right? You're trying to get that.
Yeah.
You're trying to get that debt. You're trying to get it yesterday. So there is genuinely a drive towards fulfilling
Outcome.
that first, very, very important step. Only afterwards might the focus then shift.
So that aftercare piece.
Yeah, absolutely.
Which is a very slow burning thing.
Well, it also doesn't pay very well. That's the other thing,
Yeah.
right?
The incentive isn't there.
Yeah, so, and mortgage brokers are trying to build these trail books and they're doing okay. But they will typically then put other people on the care and maintenance of that book. And they'll step in where they need to, but they'll have other people making sure that the rollovers are happening and that people are staying in touch and that sort of thing. But it's still really high touch.
Yeah.
An insurance advisor doesn't have anywhere near that same level of touch as a mortgage broker does, because somebody's always got something coming off when you're fixed.
Yeah, they keep you
Right.
Yeah,
they
that's
keep you
true.
busy in New Zealand versus like the US where you can get a 30-year
Yeah,
fix.
totally. Yeah,
You know,
Imagine that.
they keep you busy.
yeah. There's a lot of that.
You get to think a lot more
Yeah.
often. Maximum 5 years.
Absolutely. And so insurance advising, obviously, you can get away with not talking to someone for way longer. And the thing is, even when you're contacting people to say, hey, look, it's time for a review.
They're like, I don't want to
Whether
do
they
that.
come back
Yeah,
to you
exactly.
or not.
Yeah. So, you might go for years without actually talking to someone. That's a thing, even if you've been trying to see them. They might, unless something changes in their world. This is actually where Planolitix is super useful for advisory, because it really shifts the focus off product, right? It's all about the person in front of you. Who are they? What are they doing? Where are they going? And it takes it to that strategic, high-level perspective place about, okay, this is you, this is your world. Now, then you would afterwards, once you knew more about them, that's when you'd start talking about the nuts and bolts of what you might be able to do for them.
Yeah.
And then refer them on to people for anything that you might not do. It's a total shift. It really, really takes it away from sales and product into consultancy. And being strategic, which I think is critically important for financial advisors to move in that direction. It's kind of the value really over time that they're going to add.
And it's the only real way to survive if you're not a large player as time goes on, right? Because independent advisors and brokers are going to become smaller and smaller because there's a lot of consolidation in the market at the moment, especially, but in general. And, large companies with succession plans and are just big corporates can buy books very cheap and roll them into their book. And there's that kind of, like, how do you stand out if you're a small independent or a boutique kind of little place?
Yeah.
If,
You've got to have an angle.
An angle has to almost be directly correlated to the level of value and empathy, I guess, you have for that individual situation, which is not scalable. But it can be if you have good systems, I guess.
Well, yeah, good tools are a thing. I mean, seriously, some of my clients, they use the software better than most of my advisors. And they love it. Like, they're in there and checking on their world and, and then they'll call me, which is great.
Yeah.
Because it means they're actually getting value between visits.
Yeah.
But they're also then leaning on me to go, hey, am I doing the right thing? Or I'm about to do something. Does this look right? Which is really important. So many times, a client over the years will come in and they've already done a thing and not called. And you've gone, you did that the wrong way. If you'd done it a little bit different, it could have been a better outcome.
Yeah.
And it's so the clients that do start to see you as that navigator on their financial journey to help them avoid pitfalls too. That's another biggie. Seriously, people will typically make their own way and make their own money and do okay, even without you. But sometimes they will do dumb stuff that sends them backwards a decade.
Yeah.
And it's avoidable. So one of the biggest value adds as a financial advisor is actually stopping them from doing dumb stuff. And I totally see that as a very real part, tangible part. Well, it's intangible, but I feel differently.
So, like, when is the best time for someone to connect with someone like yourself? So is it...
It's always yesterday, seriously. Look, there's a real myth that financial advice is either expensive or hard to access.
Yeah.
I know so many advisors that just, they give of themselves. Look, good advisors, they're really, really giving people. They want to help. That's the whole reason they do what they do.
Yeah.
And the reason they do it like they do it. So invariably, there's plenty of people out here there that are absolutely willing to help. You do have to be careful of those advisors that are trying to reach into your pocket and take out as much as they can for them. It's a thing, it's a problem. And of course it ruins it for everyone else.
Yeah. So like, if it's someone coming out of university, they're getting their first job, see a financial advisor, planner. Would be a good,
Yeah, look, I had a session the other day with one of my existing clients with his son.
Yeah.
He said, look, he's just, he's off to university, he's doing commerce, going to do his BCom and pick up some other bits and pieces as well. He's really interested in a bunch of different things. He doesn't actually know what he wants to do. Would you be willing to have a chat with him about career and about strategy and all that stuff? I go, yeah, absolutely. I love that stuff. It's super fun. I think that's really actually missing from human resources as well. Yeah. Seriously, financial services in combination with human resources, you can reduce so much anxiety
and churn
for someone. And absolutely, yeah. And I think corporates would actually appreciate their people doing a bit of extra training. And so that they could employ them internally and give them the opportunities internally, because obviously recruitment consultancy is incredibly expensive, right? So if you can actually educate your people internally and make them, build them and grow, and then pay them more, that actually everyone wins from that.
Yeah.
So what's missing is the reason why. I see it all the time. Every time I'm talking with people like 35 and under, and particularly in their 20s, it's always like, look, your world right now inside my software is meaningless. I can put a bunch of stuff in to show you what the future could look like.
Yeah.
Let's talk about career path. What are you doing? Where are you going? How are you getting there? And is there anything you can consciously do to actually improve your outcomes? Because the difference between you earning this and you earning this next amount is that, boom, you put it in, the graphs change, and it might only be a difference of 30K a year. But if you're young enough...
Yeah, it's a time thing, right?
Yeah, absolutely. Because people get lost in the zeros of their mortgages. This is the other thing I see a lot too, is that their mortgages are so big in many cases that they just can't think about life after their mortgage, or a different way. They don't realize that this, even if it's just a few years, paying that debt off faster in some way, shape or form gives them way, way better accumulated funds in retirement because they've had longer to save.
Yeah.
And the sort of money that people are throwing at their mortgages, when it's, 60, 70, 80K a year, if you're no longer having to do that anymore and you start throwing that into investment, the amount of time you get, because in Planolitix, there's two graphs. There's the mortgage graphs, and then there's the lifetime cash flow graphs, right? So you're trying to understand somebody's total financial resource. And as the mortgage goes down, and then the investment automatically kicks in. Because if you can pay your debt off at that rate, then you can save at that rate too, right? So the software assumes that that's going to happen. And then the graphs themselves basically become your goal. That's what we're trying to achieve. This is what's possible. Let's go for that. And so that graph, as it grows, that lifetime cash flow graph, as it grows, and the funds under management, or whatever it might be, their assets grow too, then you're also seeing how long they're going to last in retirement, right? So it's that classic accumulation, decumulation graph. Nice. And the higher you can get that peak in the first place, you're aiming for age 65, right? Then the longer that money lasts, and sometimes you get it right, it'll flatline. Your funds will never go down.
Yeah.
And sometimes can grow.
Yeah, exactly.
There's a real possibility.
Absolutely.
There are strategies that you can put in place to make that happen.
Yep.
100. There are lots of different ways to accumulate wealth, and over the next 10 years, it'll be really interesting to see the mix of assets that people choose because of how everything has changed.
Yeah.
And it's a strategy piece. Like in investing, when I think about allocating capital, and we think in our long short strategy, we think in that world, it's sizing. That's what really matters. It isn't actually often what you pick. It's getting your sizing right. And with a business, or because I see them as the same thing. A business lifetime cash flow and a personal home.
Yeah.
A household. There's no difference in my mind between a government company or individual or household. Like, we're all basically running our own little businesses, our own little personal businesses, right? And that strategy makes a huge difference. And none of those graphs are going to turn out to be true, right?
Absolutely.
But it's about taking the time to strategically think about it.
Yep.
Because that act is what's going to get a better outcome. It's not that you're going to hit this magical number necessarily, but you have a better chance of hitting that number.
Yeah.
Because you've taken the time to think about it.
Yeah.
And like, it's same with startups, right? No startup forecast works. But it's about the assumptions that you've taken.
That's right.
That get you kind of in the right place.
Yeah.
Hopefully.
No, it's the graphs are giving you insights about where you're at and where you could be. I sometimes talk about Planolitix as kind of like a navman, but in reverse. So with a navman, you put your destination in, and it tells you to go left and right. Okay, so with Planolitix, you put your data in, it shows you where you're going to end up. And if you don't like it, make a different choice.
Yeah.
Right? Yeah.
Totally, yeah. And people would really benefit from getting a baseline of where they're at.
Absolutely.
And that's what we really want to do for our customers, is give them a baseline to start, and then let the journey and the decisions you have to make later kind of come as they come. But I think you need to know where you're at, right? Rather than being
Definitely.
like, I want an outcome, but I'm not really sure where I'm at. I want to end up in New Zealand, but I might be in Spain, but there's a chance I could be in Italy, not really sure. It's harder to get to New Zealand, whereas obviously if you know where you are, it helps a lot.
Yeah, well, I mean, look, what's that saying? Like, pilots are off course like 98, 99% of the time. It's just all about course correction. You got to know where you're going, but then it's all about course correction the whole time.
Yeah.
So modeling's good for that.
Yeah.
What are some of the key lessons you've learnt in creating your own business?
Planolitix.
Planolitix.
Yeah.
So how long have you been working on that?
So it's funny. There are a couple of different ways to answer that, I guess. I mean, I've been lifetime cash flow modelling and learning about the intricacies of that since 2001.
Yeah.
And then, of course, I've built the software really since 2007 and working on it and using it during that time.
Yeah.
And understanding how to use it, people's different aha moments, all that kind of thing. The beauty of having an Excel sheet to hand over to a team of developers was perfect.
Okay.
Because a lot of other places that try and build software, they're institutions or otherwise, they think they kind of get a bit backwards. Planolitix is a very, very pure know your client tool. Whereas a lot of institutions will go, well, we need funds under management or we need some insurance sold. So how do we build a tool for advisors to use that will result in us getting more stuff?
Yeah.
And that's the wrong way to look at it. And I think they go wrong with that approach because they don't take a whole person view. If you take a whole person view, if you take a whole person view, then whatever advice falls at the bottom is going to be better advice. So we found some developers to help us get out of Excel into the cloud in 2018. We were in beta for a good few years, really. So we've only been trading. It's more than 4 and less than 5 years. Yeah, I forget exactly what it was. But we kind of launched in. It's definitely, actually, now that I think about it, definitely less than 5 because we launched in COVID. I remember, yeah, and we didn't even launch. It was a very soft launch.
Yeah.
We just basically let advisors in and said, right, now you can start paying for it.
Yeah.
And early on, the lessons were really less actually. Well, there were a lot about how do we communicate this. Because it was a new thing for so many people we were talking to to try and get them to understand not just the value of it and how it could take their businesses to the next level, but get all that training. And that's just still a real process for us. Just really the best way to deliver the why of why you should use it, and then how you should use it. That's a hard one too, because the advisors that use it, it doesn't care what kind of advisor you are. There we go.
Yeah, right. In terms of Planolitix, but if you were to go and start, because it's often that case of like, an overnight success is like 10 years
in the
making, and actually, like you say, from trading. But actually, the R&D that was done before then was actually a longer tail. It's like I was learning about the Allbirds story yesterday, and their story was a hell of a lot of R&D and not in market before they launched. A long time.
Right. So just product.
8 years, I believe, before they went to. They then did a Kickstarter and then ended up in market and started selling. But actually, the kind of journey is like
you got to have 8 years of R&D. Right? That's why we didn't want to hurry. And that's why it was so important for us to not take on investors, because they would have wanted results faster. And we knew that actually, because it was largely built ideally upon launch, because we'd taken so long. And I'd been using it in front of my clients for so long in Excel. So that bit was fine. But then how advisors wanted to engage with it, that's something we could have really never known without actually just going on the journey and getting more advisors using it. So there is that. There has been changes for that. And of course, we've added on a ton of stuff too. Like when it first began, it was just a pure analysis tool. It didn't have any recording abilities. It didn't have any advice writing abilities or anything like that. And now it has a ton of that stuff. But early on, it didn't. And to try and sell somebody an analysis tool for something they didn't know they needed to do in the first place. That was a thing. And yet it was so funny. Every now and again we'd come across a financial planner who would look at it and go, I've got about 5 different Excel spreadsheets that do bits of this. I think I can throw those away now. And I'd be like, yes.
You've just made their life a heck of a lot easier.
Yeah, and they were so easy because they already knew how to do it. And that just goes back to that whole CFP and the whole training piece. You get trained to do things a certain way, including the maths. So we had one particular advisor, he's over in Takapuna, and I'll never forget, he just started using it and he was getting super excited. And he sent me an email with 2 graphs. One of those graphs was out of Planolitix and the other graphs was out of his Excel spreadsheet. He says, I put the same client in both. I said, Colin, those graphs look remarkably similar. He says, at age 100, there are $600 difference. And I was like, wow. He's going, either we're both right, we're both wrong. I kind of love that.
Yeah.
You know, I didn't invent lifetime cash flow modeling any more than Xero invented accounting. Right? Yeah. And that's what I tell people because they go, oh, Royden, it's just your view. It's like, it's not my view. Stop it. There is a way to do this. I got trained how to do this. And that's the thing that actually, it's nice actually. One of the insurance companies have decided that no, we like what you do, we know you, we like you, we've seen you do really good things with your own business, and we're now going to start actively talking about you to our advisors. It's like, yay, fantastic. But the reason why, I mean, it was a slow burn, as dealing with corporates often is, but they did get over the line, and it was because they could see the very obvious, clear value, and it's all stuff the FMA want advisors to do. You know, well, one of the biggest problems they've got at the moment, they've been coming out and saying this now more loudly and clearly than they have before, and that's, hey, we're going into practices, we can see a data collection and we can see what happened, but we don't understand what happened between those points. You know, where are your workings? Can you show us your philosophy in a tool or on a page? It might be in the statement of advice. We want to know how you got there. And that's the classic 3rd step that's missing from the 6-step process, that analysis piece. And you talk to advisors and you go, so what do you do for analysis? You know, an investment advisor will typically say, oh, I Morningstar or research. I said, well, that's research, that's not analysis. And an insurance advisor will respond to that with, I use a bit of Quote Monster. And it's like, okay, that's research, that's not analysis. And then they go, well, hang on, wait, what? What do you mean?
Oh, I have to think about what I'm recommending?
Yeah. And I mean, largely, look, there is a lot about the insurance industry. They're just guessing. They're just guessing. It's rough, but when you boil it down, it's hard to say that they're not. And some of these short question sets that they utilize, where they're going into someone's home maybe, and they're asking them what they think they need. And it's like, well, hang on, you're here to tell me what I need. Don't ask me what I think I need. I don't know.
Yeah.
Do you not have a recommendation? It's like, oh, yes, I do. You just need to answer these questions in this way. It's like, it's all part of a bum covering exercise so they don't get in trouble. What they're confusing is that process is not excellence. They don't get that. Excellence is excellence.
Oh, but I tick the boxes.
Exactly, right? Process, just because you've got a process, that does not make you excellent.
Yeah.
It just means you've got a process. Does the FMA want you to have a process? Yes, clearly identifiable process, fantastic. But you've still got to be excellent, or try to be excellent at least. And you've got to be able to identify if you're not being excellent. So yeah, look, that third step, that analysis piece is missing. And what I try and explain to them is I say, look, analysis is what you do with the information you collect about that person that then makes their advice different to somebody else's advice. How did you understand their world to know what you should recommend and why and in what quantities? And you can get that from an analysis tool, and that's what Planolitix is. But we've had to educate the market on why that should be an important step.
You'd think that would be a given.
Well, you've got to remember we are this tin pot nation at the bottom of the South Pacific, and all the cool tech that is completely commonplace everywhere else in the world doesn't come here.
Okay.
It's not worth it to them.
Yeah.
They just don't make any money out of it, so they don't arrive. So our entire industry has been suffering from a dramatic lack of tools.
And access as well, right?
Absolutely.
Which drives the cost down.
Yeah.
Which hasn't happened here yet.
Yeah.
But it's happening right now.
100. I mean, I remember, I think it was last year, I went to do a demo for a boutique wealth firm. And they'd been referred by somebody else. So what they thought they were going to get a demo on was quite different to what I demoed. And I flushed it out at the end. I'm going, something's missing here. What are you actually looking for? And they went, And what they described basically was a portfolio construction tool. Right. I'm going, you guys are using FNZ? And they're like, yeah. Does FNZ not have one of those for you? And they went, they've got it overseas, but not here. Yeah. So FNZ, who started off in New Zealand, huge company now.
Hilarious.
Yeah, right? And overseas in the UK, absolutely there's a portfolio construction tool, just not available in New Zealand.
Yeah, I mean, I actually think that what Robinhood, Sharesies, all of those online brokers have done is made trading kind of individual equities and such.
Yeah.
So accessible.
Totally.
And created a whole lot of enthusiasm around, I can own assets and that can protect me against inflation and help me build my wealth.
Yeah.
But when it comes to actually portfolio construction and actually thinking about the sum of the parts, that's something that we've spent a lot of time building with Acuity, right?
Yeah.
And thinking about no, it's not about a thing. It's about what's the whole thing.
Yeah.
And actually the whole thing is made up of a lot of different other things.
Yep. Totally.
So that's I think that's the next evolution for financial products for sure. Is thinking less about access and more about maybe more strategic.
Yeah, absolutely. And where I love actually that then starts to meet a financial planning kind of approach is that strategy piece of, all right, so here's a theoretical wad of funds. This is actually, how do we then achieve the appropriate portfolio construction to make sure we're actually achieving our life goals? It's the meshing of the two where they come together.
Yeah,
right?
for sure.
It's like, okay, I mean, I tend to take a bucket approach quite a lot. Or depending on the client, it could be core satellite. It's completely different per client. But largely we want to make sure that, okay, we need to have a surety around your drawdowns.
Liquidity, right? And that's something, again, New Zealand's very bad at is investments that are not liquid.
That's right.
that then make life a little bit hard if there's a event where you need liquidity. And that's obviously the benefit to marketable assets, is that marketable assets you can typically, not always, because sometimes there's not a buyer, but typically they're liquid enough to get access to fast.
Yeah, so we try and focus on, like, we need to make sure that because it's the other thing too, it's not just the ability to get the funds to them for their spending, it's a mental game as well. It's that behavioural finance part. It's reducing their anxiety so you can then take more risk with the rest of the portfolio.
Yeah.
Because you're not going to need it all yet. This is out here doing its job for your future. This is the bit you're going to need over the short term, and we've set it aside in a way that means that it's there for you.
So did you ever get into Dave Ramsey and his YouTube?
Look, I discovered Dave Ramsey through one of my clients, actually, who kept going on about him. And I sort of tuned in.
He actually is a person that originally got me into investing.
Okay.
Yeah.
He seems to be he's very specific about some things. And then when it comes to investment as a whole, he says, go get an advisor, and and it gets very vague very quickly.
He loves mutual funds, and obviously he's a big property guy.
Yes.
Loves property, loves mutual funds. He's not, but what he made me think about more was, the baseline. What situation am I in, and where do I need to get to, and where do I need to get to in order to not be, like, because obviously in the US it's a highly debt-driven society, more so than here, and the access to debt outside of your property is readily available. So you just end up with people like that. You listen to his segment and you hear these people that have got $600,000 in student debt.
Yeah,
it's like,
I mean, if you're going to be a surgeon, you might be able to get your way out of that. But
that's crazy.
It is.
That's wild.
Yeah.
Right. But he'll try and work out a way to at least help you from a step-by-step approach. Manage that and get somewhere. So it's kind of fun hearing the stories, and then how he then, after berating them in his typical kind of American approach, then kind of at least gives some actionable. Okay, let's do this, and this, and then it's cool, because everyone just needs a plan, a path.
Yeah,
a path to a future that could be better.
Yeah. And look, it doesn't have to be hyper formal. That was one of the things that sort of changed, I guess, from when I did my early training. Everything was like, we must deliver these 40-page financial plans that nobody reads.
Yeah.
Or they do read it. They read it the once, and they get across the line, and they become clients of the firm, and that's great. But it's an important document, and it must be reviewed, and it'll go into a bottom drawer, and they'll find it when they're cleaning up 5 years later.
Or moving house.
Or moving house, exactly. So that's something I kind of changed my viewpoint on when I started, when I went into the business for myself, was that I kind of went, you know what, people actually there's two aspects to this. One, they need what they need when they need it. But the other is don't try and, force financial planning down their throat if actually they're not ready for it yet. Deal with what needs to be dealt with, but have the concept that, hey, look, this is your life is a moving target, right? Your plans are a moving target. So while I still love written advice and go to great lengths to deliver that message in an advice doc in a PDF, no longer 40 pages, and no longer printed. But a lot of it comes back to those graphs, and that's what I love about the software. It's like, hey, this is your world, it's moving. Every time you get a year older, you go in, if you've had a birthday in Planolitix, it updates it, and it'll turn a 30-year mortgage into a 29-year mortgage as well. And so the idea now very much is progress check-ins. And, so you're not calling up for necessarily an investment review, you're not necessarily calling up for an insurance review or whatever it might be, or mortgage, whatever. It's really, let's just check in and see where you're at.
Yeah.
Update the numbers. What are the numbers telling us? Based off that, do we need to tweak or change or adjust around the edges? Getting someone to come for a progress check-in is way easier than getting them to come for any other kind of review. Yeah, nice. That's what I've found.
Interesting. Awesome.
It's because you've repositioned yourself. Once again, you're that navigator on their financial journey. You're not necessarily steering that boat, right?
You're supporting them.
Yeah, but you might be going, you might want to shift a bit left. There's some rocks.
Yeah.
Right, yeah.
Awesome. Well, thank you for coming on. Really enjoyed it. Awesome.
Thank you. It's been fun.
Nice.
I didn't even know we'd started. And it occurred to me we've done quite a lot of talking.